Hey, what's up everyone? Michael here. In today's video, I would like to speak about the divergences, how to apply divergence in technical analysis of cryptocurrency. So you are likely to have come across this notion in the review of analysts and traders, but I don't think that you have studied this topic in detail. Everybody knows that divergences are divided into bullish and bearish one, but how many types of divergence can you enumerate? And the answer is 3. So, the term of divergence is quite common and it is widely used in mathematics, physics, biology, linguistics. Its nature is the same everywhere and comes from Latin divergo, that means deviate. So, in technical analysis, a divergence occurs when an indicator and the price of an asset are heading in opposite directions. The advantage of divergence in technical analysis is that, unlike most signals, divergence is a leading one. The principle of the signal is rather simple. If it has appeared, the trend is likely to reverse soon, or at least the market is likely to move sideways. Therefore, bearish divergence will mean that the price reversal downwards, and bullish one will mean that the price will reverse, of course, upwards. So, divergence signal is relevant in all time frames, but like for most signals, the subordination law works here as well. That is, divergence in a longer time frame is a stronger signal than the one in the shorter one. So, if we discuss Bitcoin in this respect, I can say, based on some of my experience, the most suitable time frame to identify divergences is 12-hour one. It is difficult for me to explain why, but exactly in this time frame the signals work the most efficiently. So to look for divergence signal, I use a number of oscillators such as a Chaikin oscillator, a DE marker, MACD, stochastic, RSI, and volume oscillators. And you most probably are wondering right now, why do I use exactly them? Well, because each of them is unique in a way, has its own features and the limit of sensitivity in different market conditions. So you can use any other oscillator convenient for you. I primarily aim at describing the very nature of divergence signal and how to correctly read it in the chart. So, as I have already said, there are 3 types of divergence, and they are: the first one is the regular divergence, the opposite to the trend, the hidden divergence, following the trend, and extended divergence. So, besides, it should be remembered that the divergence is relevant solely until the next extreme is formed. After that, it loses its relevance. So let's discuss the first example. In this chart, we see the example of a regular bearish divergence. This is also called divergence opposite to the trend. The principle of the signal is based on its name. In the chart, we see although all time highs are being renewed within the bullish trend, the oscillators Chaikin, volume, and RSI shows higher low than the previous ones. So for presentation purposes, I marked the signal with blue arrows. So, as we see from history, the signal 100% worked out, and the people who followed the signal left the market on time, having sold their bitcoins at all-time highs. In case of a regular bullish divergence, the signal works according to the same principle. That is, the indicator, despite market lows renewals, will show higher lows. Next, in the chart above, we see a good example of the opposite divergence, which is also called hidden divergence or following the trend divergence. Beginners often confuse a hidden bearish divergence with a regular bullish one, which results in bad mistakes. Traders open long positions when, on the contrary, they should look for short ones. So in this chart, it is especially clearly identified by D marker and stochastic that there is this tricky hidden bearish divergence. Its principle is opposite to the regular divergence. Here an oscillator shows higher highs which the price fails to reach. As you see, the signal has also perfectly worked out and the market following the signal slipped down into a further correction. For hidden bullish divergence, everything is vice versa. An indicator shows lower lows when the price fails to reach them. Last type is extended divergence, which often occurs during the market moving sideways, when there are not so many highs and lows. It also occurs when double bottom or double top patterns are forming, being a perfect confirming signal of the trend reversal. In this case, one needs to follow what value indicates an oscillator when the price reaches the border of the lateral, which is the sideways channel. In this chart, we see that the price had only reached the previous low, when volume oscillator and D marker showed the higher lows. This signal is extended bullish divergence. The extended bearish divergence, on the other hand, is based on the same principle. It occurs when the price highs are at the same level, but an oscillator fails to indicate the previous highs and show the highs lower than the previous ones. Okay, next step, which is how to make an analysis in real time based on divergence, I will show on LiteFinance Instagram and TikTok account, so be sure to follow there and subscribe here for more as well.